This is Sovereign Debt, a podcast on greening the global economy and debt sustainability. I'm your host, Jill Doshi. Hello, everyone. I have this image of all of you lounging by the pool or on the beach at the moment, listening to this podcast. Or maybe by the time it's published, you're back at the office, toiling away, getting ready for la rentrée, as the French would say. But in any case, I hope you're enjoying it. And today's guest is a real pleasure, not only because I have been chasing him to come on the podcast for many, many months, and we're super happy to have him today. Jim Ho is a partner at Cleary Gottlieb and a veteran of sovereign debt matters. And the challenge will be choosing what to talk about with him. So, Jim, first of all, thank you so much for being with us today.
Well, thank you for having me. It's such a real privilege to be on your podcast. So I wish I was lounging by the pool, but as you can see on Zoom, I'm unfortunately not. I'm, in fact, just seeking solace from the heat wave outside in London in my air-conditioned office, which seems strangely appropriate for our discussions today, since I think one of the many topics we'll be talking about is climate change.
Exactly. And I'm also here still sweltering away in DC in our tropics here. So absolutely, it's on our minds. So I want to kick us off mentioning something that I think that you don't want to talk about, but I do want to, it's relevant because just last week there was an article a bit prematurely, I believe, regarding a guarantee that's being provided by the Inter-American Development Bank to Barbados, also with the participation of the Nature Conservancy. In the article, they mentioned about $150 million, not really describing actually what the instrument or the purpose is going to be, but it certainly piqued a lot of people's interest to see that someone else was stepping forward to guarantee. Anyway, I understand that's an ongoing deal and you're going to say no comment, but at the same time, it is well known already, and you've been very vocal about other work that you have done for Barbados a few years ago on climate resilient strategies and the bond issuance of the catastrophe bond. Can you tell us a little bit about that transaction?
Oh, that transaction I can talk about. So Barbados restructured its domestic debt in 2018 and then its external debt in 2019. And the main innovation there was the inclusion of the natural disaster clause. And the reason was really quite simple. When the decision makers in Barbados started working on the restructuring in 2018, it is hard not to look back at the hurricane season in 2017 and realize that it was pretty bad. And 2017 was a terrible year for the region climate-wise. There were 10 hurricanes in 2017, including Hurricane Maria, which killed more than 3,000 people in Puerto Rico. And unfortunately, this is a recurring theme for countries in the Caribbean. And that's why Barbados fought real hard to include the natural disaster clause in their restructured bonds. And whilst the second generation natural disaster clause appeared in Barbados's restructured bonds, the first generation natural disaster clause actually appeared in Grenada's bonds. And that was because of Hurricane Ivan. So if you look back at history, Grenada was struck by Hurricane Ivan in 2004. And the devastation brought by Ivan was uncompromisingly thorough and ferocious. Just one number that stayed in my mind was almost 90% of the houses in the country were destroyed or severely damaged. 90 by the hurricane. So much so that even the prime minister was rendered homeless when his official residence was destroyed by Ivan.
That gets the attention of the political classes, I suppose.
Definitely, right? And when you start looking at the numbers, the total damage was about 200%, right, of the country's GDP. So that was pretty tough. And for people in our business, Jill, we usually can detect a sovereign debt crisis from a mile away, right? There'll be issues of fiscal mismanagement. There'll be alarm bells being rung by the credit rating agencies or the IMF. There'll be bond prices falling. But in Grenada's case, their sovereign debt crisis did literally happen overnight, right? Following a random external shock. So given what we know about the kind of damage that natural disasters could bring, ranging from Ivan to Maria, the Barbados's policymakers were very insistent on the inclusion of the natural disaster clause, even though they faced stiff opposition from the creditors. But ultimately, we succeeded. And now Barbados is the only country in the world with a climate resilient public debt portfolio because of the inclusion of the natural disaster clause.
What were the arguments against such a clause? But you mentioned the creditors. Is it just that they thought this should be something that insurance companies should be handling and it shouldn't be embedded in bond documentation, or was there other arguments?
It's as if you were in the room, Jill. Yes, that's the kind of thing that the arguments that the creditors lobbed at us. And they also said that, look, fixed income investors are pretty simple creatures. We've got a model that we know how to use, right? And we know what those models look like. And when you start introducing clauses like the natural disaster clause that introduces probabilistic uncertainty into the pricing, then that just throws the model out of whack. And so they can't price these things. But
except they're very good at pricing options.
Exactly. I think that's probably a different desk within these investors. But for the pure EM fixed income investors, this is just not their bread and butter. And yet, at the same time, if you look at the big bang of ESG or GSS financial products in the last few years, that hasn't stopped them from pricing those kind of instruments. So perhaps, the pricing mechanism can be improved, and hopefully will be improved, since these kind of clauses, I think, are here to stay.
Right, because they're really. So let me step back for 1 second. Let's walk through the mechanics of actually what happens. We can use the Barbados ones or the earlier Grenada ones, but in both cases, it's actually linked to the event of the catastrophe, of the storm, of the cyclone or hurricane. Well, let's ask that question first. Is it linked specifically to a particular type of event, or is it the damage of the event?
Right. So maybe we take 2 steps back, right? So let's talk about the basic idea of a hurricane clause or a natural disaster clause is really quite simple. So if a natural disaster occurs, then the debtor country will be permitted to defer payments under the bonds or debt instrument during a prescribed period. Right. So if the trigger conditions are met, then all interest and principal payments, for example, falling due within the next 2 years after the natural disaster, will be postponed. So the idea is that this allows the country to channel the funds that would otherwise go towards servicing debt towards more immediate needs of the country during the immediate aftermath of the disaster.
If the trigger is met, then there's an automatic rescheduling. It's not a cancellation of debt. It's not a kind of forgiveness of anything. It's just kind of as if, well, for those of us who've been following all of this, is kind of a DSSI or kind of a Paris Club rescheduling. It just kind of tacks on those payments later.
Exactly. It's an automatic liquidity relief mechanism. It doesn't mean that the issuer will not be paying back the debt owed. So I often tell countries to think of the natural disaster clause as the lightning rod for their bonds, right? So the clause will just help to insulate them against the immediate negative financial effects of the natural disaster, but you still need to pay for it eventually.
Right. Okay. And then the trick is defining the trigger.
Exactly. And I think that's one of the misconceptions about the natural disaster clause, because people think that you necessarily need an insurance product to layer on to the natural disaster clause, but it's not. So the way to think about it is that the trigger is linked to a payout under an insurance product. For example, in Barbados' case, it was linked to an insurance payout under the Caribbean Catastrophe Risk Insurance Facility, or CRIF. But many Caribbean governments are already members of CRIF. So I think there are about 19 Caribbean countries and 3 Central American countries members who are members of CRIF. And since they've already purchased insurance against the risk of hurricanes and other natural disasters from CRIF, using CRIF payouts as a trigger has two main advantages. So one, it is a determination by a third party, which is CRIF, that a natural disaster has indeed occurred, and therefore it mitigates the problem of moral hazard that someone within the country is saying actually there's a natural disaster. So this is a third party that actually has to pay out under a separate insurance contract.
Just in case the sovereign was going to pretend they were hit by a giant hurricane.
Exactly. But we heard arguments like that in the
I'm sure.
negotiation
No, I
rooms.
know. I'm just being cheeky.
I know, and you sometimes when you hear things like that, you just go seriously. Like, which sovereign would actually pretend? Okay, who can actually pretend that?
Yeah, it's not like gaming your GDP numbers, but okay, I get it. Okay, so it's verified by a third party. It is deemed a serious enough event to have triggered an insurance payout by a very credible third party. So that would, the payout of that insurance policy is what would trigger the postponement of the debt payments.
That's right. And also that helps with the determination of the de minimis trigger of the de minimis amount of the trigger. Right. So the natural disaster clause can only be activated if the moderate loss under the insurance contract is at least a set amount. So this is also a form of protection for the bondholders, as the government will not be able to trigger the hurricane clause if the hurricane does not result in a material damage to the country. And in the case of Barbados, when you want to compare it side by side with Grenada, there are three main differences. So one, for Barbados, we added more trigger events. So in Grenada, they only had tropical cyclones, but in Barbados, we added earthquakes and floods in addition to tropical cyclones. And secondly, we also help to deal with the moral hazard issue by including a blocking right for 50% of the bondholders. So if Barbados elects to trigger the natural disaster clause, then 50% of the holders can block it if they think that this is an illegitimate triggering of the natural disaster clause.
Okay, so if more than 50% of the bondholders think that for some reason there's been an abuse of this clause, they can force it to stop, and then that would ultimately probably force everyone to the table to negotiate something.
That's right. But then from the perspective of the creditors, why force a restructuring with the attendant issues of cost and timing and heartache that comes from an actual negotiation of restructuring when you know that there's a real natural disaster. Clearly, the country is going through a time of reconstruction. So let's just give them 2 years to deal with it, right? So it's also not in the interest of the creditors to go force a restructuring when you don't need to. So this, the clause is, even though it's quite simple, it basically automates a restructuring, right? Without anyone having to come to the table, right? So that's actually one of the beauty of the simplicity of the clause.
Interesting. And when we look at the use of these clauses so far, to my understanding, and correct me if I'm wrong, it's been in kind of smaller country situations and smaller island states, obviously, because we're talking about the cyclones. But can we extrapolate from this idea into kind of larger situations or other sorts of natural disasters and triggers? I'm thinking of, earthquakes and landslides and other dramatic events, wildfires.
Oh, definitely. I think one of the trigger events that we've been drafting recently is, how do you define a pandemic? Because everyone's looking at, COVID and thinking like, oh, we need a pandemic event trigger or natural disaster clause type concept and different financial instruments. So people are thinking about these things, but for small island countries are now the most vulnerable to climate change, right? So it's definitely an important innovation for them. And the front line in the war against climate change is basically there. Sea levels are rising the highest, temperatures, doing the greatest harm in flooding, droughts, forest fires. They're all intensifying in countries in the tropics. But as you rightly say, we're also seeing the negative effects of climate change in the Western world, from flash floods in Germany to forest fires in California. So, but I think the main difference here is that Western countries have deeper pockets, right? So unless they really need to issue bonds with different type of concepts in them, like the
Yeah, so
natural
I wasn't
disaster
really
clause.
thinking of like, California and their forest fires or something. I was thinking more like Pakistan or something with earthquakes. And in the moment now, I'm having a blank of any other sort of natural disasters. But
Yeah, volcanoes, for example, right? But you can definitely extrapolate from this and think about countries are most at risk, right? In the Caribbean, for example, every summer people worry about the winds coming from Western Africa, right? Because that could potentially become a hurricane, and then chaos and catastrophe ensue. So if you're living in the shadows of a volcano or in an earthquake zone, then certainly it's something that you should be thinking about.
do we think that inclusion of these clauses makes the debt more expensive for these countries?
I don't know, actually. I think someone probably should do an analysis into that. I was told that was perhaps like one of the arguments that people put in, but surely it's a good thing, right? Because there are benefits to these clauses, including making a disorderly default less likely, right? And so that must be beneficial. And it's a bit like the collective action clauses. Some people said that putting those in would make the debt of a country more expensive, but it didn't. Right? I think the various analysis research papers out there that show that it didn't make a difference. So perhaps this won't either.
Well, and in theory, it's making, as you said, kind of more climate resilient. So if you're already willing to invest in these small islands, presumably you're already aware of their risk and exposure and vulnerability to climate change. And so the fact that they're kind of being proactive about solutions.
I would think so. Yeah.
Moving from these bonds into just kind of more broadly into the other contingent debt instruments. This is somewhat like also in some ways, I mean, correct me if I'm wrong, but GDP bonds and sustainability linked bonds that are, there are a lot of innovations and a lot of us are working on it, in the sense that payments and terms and conditions in the bond documentation are linked to certain events or certain outcomes and triggers.
That's right. I think the natural disaster clause looks a bit more like your traditional bonds, right? So most of it, the terms and conditions of the bonds look very much like that, other than the natural disaster clause included as one of the clauses that helps you to restructure the bonds, right? It's a bit like a collective action clause, you add it in, but overall it still looks like a bond, but there are loads of other products out there that are contingent debt instruments that look less like a traditional bond. For example, the GDP-linked bonds, the commodity-linked bonds, the pandemic bonds, they're all different instruments. But in the last few years, we definitely have seen a significant increase in ESG-related financing or GSS financing for sovereigns. And GSS here stands for Green, Social, and Sustainability Linked Bonds. But unfortunately, there's no formal statutory or regulatory definition of what GSS means. So it leaves a lot of leeway to the issuers and the writers to determine whether the bonds can be marketed as GSS or not. And interestingly, for some regions, it is the sovereigns who are actually paving the way on the ESG front, which is actually pretty interesting. So, for example, Latin America has typically lagged behind much of the world on ESG initiatives, but much of the new traction in the ESG, GSS world comes not from the private sector issuers, but from the sovereigns, right? So you saw Chile becoming the first Latin American country to issue a GSS bond in 2019 now. And then in 2020, Mexico became the first sovereign to issue bonds linked to the UN Sustainability Development Goals. So with explosion of GSS and ESG financing and investors looking to invest in ESG products, I think this actually offers a great opportunity for sovereigns looking to diversify and create new products that can tap into that market.
And certainly as creditors get used to some of these, thinking about these triggers and thinking about these events and these linkages between really the climate vulnerability and the credit story of a country, once they start making that linkage in their own minds, the market can grow, and once they update their models, as you were mentioning earlier.
Yeah, I think that there are two sides to the story, right? So one, you need to make sure that the creditors want to buy these papers. And on the flip side, you need to make sure that the issuers are ready to issue GSS, KPI bonds that typically have a longer term horizon. And one of the potential stumbling block for issuing sovereigns when they look at these products is the question of political stability. Right? So when you look at something that has a 5, 7, even 10-year horizon, and then you look at your election cycle, there's a real question as to whether the targets that you choose for your bonds will be supported and pursued across different administrations, and whether it can withstand political fluctuations. So I think that's something that issuers need to think about, when you go into this market and you go choose KPIs that are measurable and ambitious and all that, but also the question of political stability.
But isn't that one argument why it needs to, those triggers and KPIs need to be grounded in really the kind of the national commitments and the UN kind of the real conventions, I mean, in the real targets that the country has pledged and committed to, independent of particular political party, ideally, right? I mean,
ideally,
is the United States, which is of course like the ultimate, swinging back and forth on this issue. So, I certainly appreciate the political nature of these things, but in an ideal world, I think, at least in my experience, speaking to some of these countries and the governments in these countries that are very vulnerable, it does seem to cross political spectrum, that this is one issue that they seem to be able to agree on.
Ideally, it can cross political spectrum, but then you're from the United States, right? So you know where the two main parties stand on issues of climate change, or whether it even exists or not, right? So if the country can agree on something like that, is great, right? But if they can't, then the debt manager, being a civil servant, would need to go figure out whether this can withstand fluctuations from left to right and left again, right? And how would that work out in different administrations?
Switching to kind of a related topic, but kind of moving on, the Prime Minister of Barbados, Mia Mottley, has been very vocal and very critical about the lack of support from developed, advanced economies to these vulnerable countries. And she's been advocating for innovative financing solutions, and certainly for those countries to kind of meet their promises of mobilizing finance to them. I'm just asking you just a very broad question first is, do you think anyone's listening to her? Do you think that the time is coming, where that is actually those promises are going to start to be kept? I mean, we've had this week as well in the United States, a lot of celebrations over a passing in the Senate of the Inflation Reduction Act, but climate, action finally. Anyway, do you think that the tide is turning, so to speak, and that the world's ready to start mobilizing?
I sure hope so. So Prime Minister Mottley had the courage to say difficult things that people don't want to hear, issues of climate justice, legacies of colonialism, structural inequities of the global financial system. These are all tough topics to talk about, and yet she's talking about it, and people are listening, right? And with the effects of climate change bearing down on countries in that region and other countries around the world, and that distress on the rise, the kind of austerity in the aftermath of a crisis usually see demanded from the official sector would no longer work in this new world, right? You need an economic program that would work in the face of a potential natural disaster. This means better schools, better hospitals, better infrastructure, better civil service, and all of which needs money. And on your comment about the US, it's interesting, right, that things are actually happening in the US, and there are good reasons to celebrate. And yet, if you start looking outside of the States, especially towards the emerging markets, so 41 countries now are at risk of that distress. And I fear that the world, unfortunately, is not paying nearly as much attention to the debt problems faced by the countries in Asia, in Latin America, in Africa, as it did to, for example, similar issues faced by European countries a decade ago. Right? So the attention of the richer countries are also diverted and diluted, by situations in Ukraine, right? Inflation, the uncertain exit from COVID, commodity supercycle, tightening by the central banks. It's just a lot of complicated things happening, and it's a very challenging policy environment for us to operate in. And so, whilst we are seeing steps in the right direction, there are also push factors pushing us back to where we were, especially if we get a bit complacent and we just take one step forward, two steps back. That's certainly not where we should be heading.
No, I totally agree. And I think for a long time, at least in the sovereign debt world, we kind of knew that the architecture was getting rusty and maybe not working as well, but we were kind of blindfolded and just, I don't know, tweaking it and moving forward. And there were innovations and the CACs and all of that stuff. And I'm not saying that we just were drifting.
Common framework.
Yeah. Well, and that's where I'm going is the pandemic kind of hit, and there was a feeling that we had to get real and recognize the real true state of many of these countries. And I'm fearing that the response back, from the G20, although it was a great first step, and the DSSI was really a landmark in the sense that the G20 came together and did respond and fairly quickly, and then we had the common framework. But it seems we need to kind of keep going and keep re-energizing that spirit of multilateralism and multilateral kind of solutions to these problems. And as you mentioned, we have so many different kind of challenges happening right now that make that multilateralism extremely difficult. So again, another kind of hard question for you is do you think we're going to be able to kind of work with the common framework and make it more attractive to countries? And for those who do step forward, and whether they want to or not, say that they, step forward and say that they need the assistance, is there a way to reform it? And instead of just saying, "Oh, it's terrible," and we have to start over, but we've got to start, and how do we move it forward? And one thing that I keep thinking about is there a way to kind of bring some of these issues together to actually create something new for the 21st century, and greening the common framework, so to speak? Does that help, or does that just complicate it even more?
There are lots of questions in that question. No, I think, again, I'd like to take two steps back, right? And just think about, for example, the common framework and figure out why was the common framework introduced in the first place. And when no one reads the common framework, there's nothing common or standardized about the framework. Yeah, exactly. It's just you should probably just call it the uncommon framework. Right. But the value added by the framework was to really bring newer official creditors, such as China, into the process, similar to that of the Paris Club. Right? If that's the gauge, then China is showing that it's willing to participate in the common framework discussions, notably for Zambia. That said, like you, I think there are so many different things that one could do to make the process more efficient. For example, we can clarify what comparability of treatment actually means here and how it could be effectively enforced. And that is not a new problem. There was a problem for the Paris Club process, remains a problem for the Paris Club process, where the comparability of treatment is more art than science. Another way to think about this thing is to just have a more prescribed process. For example, the creditors and the borrower could agree to a timeline so that the discussions do not drag on indefinitely. Because the more you delay, the worse situation becomes for the borrower country. And maybe an even more ambitious thing that one could do to improve the common framework is to impose a debt service moratorium. Right. So if you freeze debt service, one, this would provide interim liquidity relief for distressed countries. And second, it would also act as an incentive to make sure that the restructuring proceeds expeditiously. So if you just put little improvements to the process there and just make it a bit more standardized and people know what to expect, that'd be great, right? Because currently just the lack of transparency and lack of clarity as to what the common framework actually entails, I think it's a problem for both the official sector and also private sector and also borrower countries, because they go into it and then suddenly it's a black hole and it's unclear what's required of everyone.
Well, and what I'm seeing is that the real difficulty in today's world, and this is going to be kind of nuanced, but I think my audience will understand, is the providing financing assurances. I think this is where the whole thing kind of falls apart. So a country is in distress. They have to call in the IMF, like all countries, they kick and scream and they try to avoid it. And they try to think of all sorts of other ways to kind of work around it. And they borrow from all sorts of friends and family, but eventually that runs out and they have to call in the IMF. But the IMF can't really provide support unless they are assured that they're going to be paid back, right? And in the old days, that assurance was easy to provide because you had the Paris Club and you had the commercial creditors be commercial banks that were in those countries, right? So it was kind of a smoother process. In today's world, you can't give those assurances because you have no idea what the bondholders are going to do and you have no idea what your other official creditors are going to do. And I think the common framework was trying to attempt to create a framework whereby that assurance could be given to the IMF more quickly. But that it still doesn't work. And so we see Zambia kind of struggling to provide those assurances. The bondholders don't want to agree until they know that China is going to agree, and China doesn't want to agree until it knows that everyone else is going to agree. And they don't want to make a decision yet because they just don't know what it means for the whole rest of the world. And so the whole system kind of stuck. Is there a way, thinking of the hurricane clauses and the natural disaster clauses that we were just talking about, could you have a trigger that is not a natural disaster, but actually just a financial disaster? And if you kind of call in the IMF, could that be the trigger? Could you just then say, I've called in the IMF, and that's going to kick in very much like the natural disaster clause, just give some automatic relief, which would then possibly, does that provide a financing assurance?
Oh, I don't know. I think that creditors would probably balk at that, right? Because that's usually an event of default, not an automatic debt deferral provision in their bond contract, right? So if you declare moratorium, that's it. They can go to court and start accelerating on the bonds and find assets to attach. But I I think that the world is indeed changing, right? And you're dealing with various constituencies, all with their own heartaches and issues and problems to deal with. And I think China is an interesting one, right? Because they are facing their own challenges. It is well known that China is the largest bilateral creditor to the developing world, in particular the Belt and Road countries. But the magnitude of the potential debt distress there is causing a major policy headache for China. Right? So China has had to negotiate or renegotiate many of these loans, write-offs, deferrals, reductions, etc. But as increasing number of these loans start to blow up, China will find itself in a position as if it's the IMF having to provide rescue loans, right, to some of these countries, which they've already started doing, according to some reports, to prevent some of the debt distress situation or brewing currently from becoming full-blown balance of payment crises for the countries. And even though China has a lot of reserves currently, when you add up the numbers, this could put a great strain on China's coffers. And the question is like, what would this new world look like? Will China continue to be the friend and family of many of these countries, or will they stop? And they are also beginning to pull back from some of the new financing, right? So, in the last 15 years, again, you look at the numbers, it's clear that the Western world has pulled out from lending and to the emerging markets and the developing world, and that's why China became the largest single creditor to the developing world. And whether now, with the tide turning, whether the traditional Western donor countries will now step in to increase their foreign support is anybody's guess, right? Because we are facing tougher economic conditions at home. And how do you deal with the financing gap left by everyone as the economic conditions tighten?
Isn't it in some way that the answer is to use public money in order to bring in the private money through credit enhancements or some sort of guarantees, rather than actually just having to bankroll it themselves?
Definitely. I think one of the constituencies that is often forgotten in this discussion is, what can the private sector do here? And credit enhancements is a great way to do it. The official sector could share their halo with the private sector in these structures, like the AB loan structure or co-financing structure. And the private sector is already making a big push into ESG financing. So hopefully with all these things out there, this would lead to further developments and innovation and inclusion of private sector money, because you need to leverage off the official sector or the public sector money and get in more private sector and get the economy flowing that way. Again, because you can't continue to bankroll it using public money forever and ever.
And when you talk to that donor class, so to speak, one of their concerns is, well, they don't want to give a free ride or, make it easy for these, commercial creditors or bondholders, which sometimes they are still demonizing in some way rather than looking at as a partner. Do you hear those same sort of complaints or concerns?
Well, sometimes, but I think the discussions are definitely more nuanced now, right? Because the official sector is they need to report on the use of public money, right? So obviously they need to make sure that they do not end up subsidizing the private sector. But then there's a thin line between a subsidy and also a partnership, right? And to use that and to find ways to make sure that there are new structures out there that could be used and mobilized, especially in a debt restructuring situation. I think theoretically, folks have been discussing all sorts of weird and wonderful structures to bring in private sector money, so that it's not just all IMF bankrolling or funding the bailout. And yet, I think there is, as you said, some resistance still on
and
how
I
that
think
can be
that's what
used.
I'm getting at. There has to be some way that when a country is in distress and going forward, and let's just call it to the common framework, that there is some creativity coming of how we work with the IMF analysis, with the private sector, and how the debt restructuring and the process is more kind of collaborative rather than everyone in their silos, and which I think is the way it used to work. So we have to kind of get creative. I think we're all still circling around what that could be, though.
I think so, but no, we've the process, as you said, right? There is this slow evolution in how sovereign restructuring is done, even over the last 20 years, right? So hopefully, in this new world, there'll be new innovation, new technology, and new developments, and we can find ways to make it more collaborative.
What are your views on the IMF Resilience and Sustainability Trust? I know it's still in the works and it's not yet operational. Kind of really, we'll get to see what it really does in October. But what are your hopes and dreams for the RST?
Well, I think it's great that IMF has added the RST to its lending toolkit. Right? It's longer dated than most of the loans that IMF does. I think it's a 20-year maturity with 10.5-year grace period. And the interest rates seem quite low. I think it's just a small margin over the 3-month SDR rate. And also concessional financing is available to the poorest countries. And also, I think they are targeting a significant war chest, around $45 billion for this. And this can be a hopefully meaningful way to fight against climate change. So I'm optimistic that this will be a good thing.
And then my last question, which is really just kind of tradition at this point, is like to give you the last word. We know we've got a lot of listeners really all over the world. So what would you like to tell debt managers or anybody listening about these structures that we've talked about, or anything else?
2 things. So if you want to learn more about the natural disaster clause, so you can go online and just search my name, Jim Ho, and natural disaster clause, and you should be able to find the article that I've written on the Cleary Gottlieb website on that subject. Secondly, if you want to learn more about climate justice, then you can go on YouTube and watch Prime Minister Mottley's speech at the COP26 climate summit last year. And to quote her, we all need to try harder.
Brilliant. Fantastic last words. Thank you so much, Jim. It's been a pleasure to have you.
Thank you for having me.
Thanks for listening. If you enjoyed the episode, leave us a review and subscribe to the show wherever you get your podcasts.